Good afternoon and welcome to Cambridge in Americas, a conversation about philanthropic estate planning. My name is David Manns. I am an alumnus of Trinity College and a member of Cambridge in America's Boston Regional Committee, a group which aims to promote Cambridge and increase engagement among alumni in the Boston area. Some of you may know me as Secretary of the Oxford and Cambridge Society of New England. I have the great pleasure of introducing today's speaker, a fellow Bostonian and a Trinity Hall alumnus, Martin Hall, Esquire. Martin is a partner at the law firm Ropes & Gray LLP, based in Massachusetts. He joined Ropes & Gray in 1986 and has chaired its private client group since 2006. Martin's practice is concentrated in the areas of wealth management, estate planning, trust and estate administration, and charitable giving. He is a frequent speaker at national and local charitable giving and estate planning programs and has been quoted on various charitable tax matters in the Wall Street Journal, among many other accomplishments. We are very lucky and excited to have Martin here with us today. Now it is my pleasure to hand over to Martin for what I am sure will be a most informative session.
David, thank you very much for that very kind introduction. And Cambridge in America, I thank you for this invitation this afternoon to discuss the importance of estate planning. Human nature, being what it is, thinking about long-term illness, thinking about incapacity, and then particularly thinking about our own mortality, are not necessarily subjects on which we want to expend our mental energy. Instead, our well-honed tendencies to procrastinate, to kick that proverbial can, or to put in place a quick fix to come back and do something more comprehensive later, they take over. The one thing I've observed in this year, in more than any other of my 34 years of practicing in this area, I think heightened by the debilitating medical crisis and the other challenges that we've seen, is that we must, challenge that thinking and that tendency to put things off. And that we should all be prompted to have in place an effective plan that protects us, that protects our families, no matter what stage of life we have reached. So with that in mind, and if I could ask if my slides could be advanced, what should we be thinking about? And sort of why do we need an estate plan? As I just alluded to, an estate plan really deals with the management and the disposition of property. And oftentimes there's a thought that an estate plan is really a will and nothing more than that. As I hope I will illustrate today, maybe somewhat superficially because we can't dig in too much in 30 minutes, but I hope I will illustrate. I tend to think that a will is almost the least important document in an estate plan. Its role should be simply to fill in the cracks, to cover things that maybe have not been covered in the comprehensive process. And in many ways, it should in fact be sidelined. So what are we really talking about? Well, we are talking about, I think, two critical issues with respect to property management and property disposition. The first is what happens if either through protracted illness or through diminished capacity, you're no longer able to give attention to or no longer capable of managing your assets. And in those circumstances, there are critical documents that need to be in place. The most important of which I think is to have a power of attorney authorizing someone else to act on your behalf in business and financial matters. I'm often asked, well, can't my spouse, automatically handle these things for me? Can't they sign the tax return for me? Can't they handle my checking account? The answer is no. Maybe if they are a joint owner of the checking account, they can, and in fact, they would be able to. But if the checking account or the investment account is in your sole name, they are not authorized to act absent a proper power of attorney. Another document that I advocate greatly with my clients is to have their ultimate estate plan, but also the management of their assets handled during lifetime through a revocable trust, where trustees are appointed to take over in the event that you do become incapacitated. And trustees are authorized not only to use trust property for your benefit, but also for the benefit of your spouse, for your children, for grandchildren, and other family members. And we're focusing here on property, but another critical thing that needs to be dealt with during incapacity is to provide directions about healthcare. Everyone should have a healthcare proxy or a healthcare directive. State laws give these documents different names. But once again, a spouse or a child is not authorized to have access to medical records, not authorized to talk with and approve medical procedures and surgery in the absence of these documents. These documents can also set forth your wishes about circumstances such as a terminal illness or such as long-term debilitating mental deterioration, and make it clear to the family as to your wishes for invasive medical procedures, or whether you would prefer to be at home, or whether you would want them to sign do not resuscitate or no code orders. So very, very critical documents to have in place. If you could turn to the next slide, please. Next circumstance, as I said, dealing with our own mortality is even less fun than dealing with our incapacity. But again, critical to have a comprehensive, coordinated estate plan that deals with these issues. I'm often asked, well, why do we need all of these legal documents? Why should we be paying for these things to be prepared for us? Can't we just handle it through state laws? Can't we handle it just through beneficiary designations, or owning things jointly with our spouse, or owning things jointly with our children? My response to that is quite simply that you never want to rely on the intestacy laws of any state for the disposition of your assets. You might be surprised as to what they provide. And adding beneficiary designations or payable on death designations to bank accounts or to investment accounts often can lead to some meaningful inequalities. I've had many clients come in who maybe have 2 or 3 or 4 different accounts. Maybe they have as many children. Maybe they've designated one child to be the beneficiary of a particular account. And lo and behold, one account has $10,000 in and another may have $1 million in. Obviously, those payable on death designations are certainly not helpful with respect to maintaining family harmony if left in place. So a comprehensive plan is really critical. It's also critical to think about who is going to be managing assets and handling matters for you after your death. You know, should that be a family member? Should that be a family member acting with a trusted friend, an impartial individual? Or should a professional be involved? Because there are numerous decisions that need to be made, and some of those decisions have significant financial implications. So it is critically important to think about who has that role. And then there's the issue of privacy. I mentioned earlier that during lifetime, it is good to have a funded trust, to put particularly investment assets in that account so that another trustee can handle them for you should you become incapacitated. But it's even more important, I think, for protecting privacy. We often hear about the probate process, and what we hear about the probate process is how long it is, how expensive it is, and how irritating it can be even to have to go before state courts. Recent changes in the laws of many states have made have streamlined that probate process and have made it less easy. Some states do still charge very significant fees for larger estates, and so the probate process does have that cost. But I think the biggest cost with the probate process is the lack of privacy that is afforded. Everything in the probate process, at least in the jurisdictions in which I have practiced and in which we have administered estates, has been a matter of public record. So it's out there for all to see. And that includes people who you would prefer not to see that information. And that information includes the size of the estate. I just want to sort of alert you to the fact that that various organizations have reported that each year the identities of over 2.5 to 3 million deceased Americans are used to apply for credit cards and loans, or are used in other ways to try to gain financial advantage. One particularly, what I think of as a rather heinous thing, is that false tax refunds are often filed on behalf of decedents. And in the last statistics that I saw, over $5 billion in 1 year was actually sought through false refund applications filed on behalf of deceased taxpayers. So maintaining privacy, I think, is critical. If you could advance to my next slide, please. Other things that need to be considered as part of a comprehensive plan: protecting young children, providing for appropriate management vehicles. If you don't, and you rely on state laws do give us guardianship of property provisions, but those terminate at age 18. There aren't too many of us with 18-year-olds, and I have one, and I also have a 17-year-old who would trust them with significant money at this point in time. So those laws are really not to be relied on. Creditor protection for beneficiaries. I work with many individuals who are trying to get protection for themselves to ensure that their hard-earned assets are protected. But you, as an individual, can protect your hard-earned assets, from your children's creditors by using trust vehicles, using the so-called spendthrift trust, a Dickensian concept, if there ever was one, but one that is still relevant and very effective in the 21st century to protect those assets from your children's creditors, whether those creditors be judgment creditors, whether those creditors arise because of an accident or a tort liability, or whether those creditors are a soon-to-be ex-spouse of your child. So that can be extremely important as an extremely important part of the overall planning process. I referenced earlier reducing family disputes. Maybe that's somewhat of a pipe dream, but I do find that a well-drafted plan helps to mitigate issues that can arise in the family particularly if that plan has been discussed ahead of time in the family and the plan does not come as a surprise to loved ones once the decedent has passed on. Tax issues, tax tails often wag the dog, but it is critical to make sure that tax preferences, that tax deductions, tax exemptions are effectively used and do not go to waste. And this is a critical element of estate planning, not only at the time of the decedent's death, but again, thinking about the future and thinking about making assets available to family members, but not necessarily subjecting those assets to taxes when they pass on, and the assets then can go to the next generation. And finally, and most importantly for our subject matter today, creating your charitable legacy. There's nothing in state law, no part of intestacy laws that say that any of your assets will be used for charitable, philanthropic, or other social welfare purposes. If you provide nothing, if you do not have an effective estate plan, you do not cover this, no assets will go to charity at the time of your death. So having a comprehensive estate plan is a critical element of fulfilling your charitable legacy. Okay, so can you go to the next slide, please? I'm often met by people who, in my office, who say, I have a comprehensive plan. I did it 15 years ago. I'm sure I don't need to change anything. And while one feature of most estate plans is that the elements of them can always be changed. So that is critical as we think about our planning. One thing to avoid is the mindset that once done, it does not need to be revisited. First of all, documents can go stale. They can go stale just by the passage of time. Walk into a bank and try to use a power of attorney that is 20 years old, and you may find that the bank will not honor it because they are not sure that it reflects the wishes of the person who signed it. So refreshing documents such as powers of attorney or healthcare directives every 3 to 5 years, I think is a very, very good practice. Looking at the people that you've named to fiduciary roles, whether as your executor, as trustees for your children, or in the power of attorneys or healthcare proxies is important. Maybe those persons themselves are no longer capable of fulfilling those duties. And also, as you look over plans, you may see that your priorities have changed. You may have thought about for example, certain charities that you wanted to benefit, and in more recent years, you have been supporting through your annual giving different charities. Suddenly, you will now discover that maybe your charitable legacy is somewhat stale and needs to be updated. So these are all things that I think need to be considered constantly, in addition to maybe changes that you may want to make for provisions for your children and your grandchildren. Next slide, please. Tax laws change. It's surprising. We often think that tax laws are immutable or should be immutable, and people argue constantly over whether we should be changing them. Having grown up in England, I remember governments particularly in the 1970s, changing tax laws every 2 to 3 years and changing them dramatically. So I certainly grew up in an environment in which things were constantly evolving. But tax laws change considerably from time to time here in the US at both the federal and the state level. I've just mentioned here 2 recent changes. One with respect to retirement accounts. Retirement accounts recently under the Secure Act, the payment of those retirement accounts after a person has died has been changed dramatically. The concept of stretching out payments over a beneficiary's lifetime has, except in certain circumstances, pretty much been taken away. And there is now a 10-year payout provision, which should prompt everyone to go back and think about how they have structured their retirement plan beneficiary designations and whether those designations are appropriate. Estate and gift tax exemptions. There's been a lot of changes with these over the years. When I first started practice, the exemption had increased to $600,000, and it was thought that was a drastically high level. Just a few years ago, beginning of 2018, the federal estate and gift tax lifetime exemption was increased to $11.58 million, and it increases again by just over another $140,000 on January 1 of next year. And we have a law that has this exemption change and revert back in 2026. So we have to keep our mind on that and the impact that it has on the estate plan. Now, with exemptions, we often focus on, well, how much will be subject to tax and how much will be retained by our family. But exemptions, I want to emphasize, can have a significant impact on how estates are distributed. Just a few weeks ago, I was presented with an estate plan with the admonition, don't change anything unless you have to, by a client. When I looked at the estate plan drafted many years ago when the exemption was but $1 million, provided for the exemption amount to go outright to the children at the death of the first of the two spouses. So when the first spouse died, $1 million it was thought was going, now $11.58 million, which was considerably more than the client's property, which had the effect of cutting out the surviving spouse from enjoying those assets during the surviving spouse's lifetime. So again, critical to review the plan, not only just to think about the impact of taxes, but how taxes may affect the disposition. Next slide, please. And state laws shouldn't be forgotten. As I put on this slide here, 16 states in the District of Columbia still have estate and inheritance tax laws. Connecticut, being the only state that does this, but Connecticut still has a gift tax. Many of our clients, or many of us, move to states which don't have state taxes, and particularly state estate taxes, particularly in the retirement years. And I'm thinking of states in the South, Florida, for example, or states in the Southwest, including California, which does not have an estate tax. But I just remind us all that people do move back, and I've had clients move back to Massachusetts, as strange as that may seem, oftentimes because they want to be close in the later years of their life to children, or oftentimes they want to be close to their doctors. And it's critical at that time to review plans again to make sure that they work properly. And there are other state laws that can have impacts on estate plans. As I put down here, over the last 10, 15 years, we've seen many changes in the ability to change trusts, the rights that beneficiaries have to information, the types of trustees and how you can structure trusts. So all of those things should be thought of as we review existing plans. Next slide, please. And then, of course, as we think about plans, we have to think about, well, what actually might happen in the future, and should we be anticipating those changes? This year, there has been considerable speculation as to what might happen as a result of the election to estate taxes. And that speculation came from various proposals that were put out by the Biden Biden candidacy, and as a result of the Unity Task Force between Biden and Sanders staff. And as the quote reads here, the Unity Task Force's mission, without actually specifying exactly what they meant, was that estate taxes should be raised back to their historical norm, which would suggest lower exemptions and maybe higher rates. In addition, the Biden proposal was to change a rule about capital gains taxes following death. And this would be to remove the so-called basis adjustment at death. So these types of considerations, which may not, as a result of the election, and particularly what happens with control in the Senate, these may not be relevant, at least in the near term. But these too are considerations that should be kept in mind as estate plans are put together today. So let's turn to charity. If you could advance to the next slide and think a little bit about the role of charity in our estate plans and how to make effective charitable gifts. So the first thing that I would mention is that our tax laws have preferences with respect to charitable gifts. As we know, during lifetime, there are income tax deductions available for gifts to charity that can offset certain amounts of our taxable income. And at death, there is an unlimited estate tax deduction for property that passes to qualified charitable organizations. And I say that very, very carefully, because the property must pass to qualified 501c3 organizations or their equivalent. It's not good enough that property passes to tax-exempt organizations. And I often see this, particularly with clients who wish to benefit social organizations. Let me just give one quick example of the ACLU. So the ACLU is a tax-exempt organization. However, the ACLU itself is a 501c4 organization. It is not a C3. And so bequests in an estate plan to the ACLU as such do not qualify for the charitable deduction. And in fact, they are taxable. If you make donations to the ACLU during lifetime, those donations are excluded from gift tax transfers. But at death, transfers directly to the ACLU would be subject to estate tax. However, organizations such as the ACLU have foundations. They have C3 organizations to which valid charitable gifts can be made at death. So important to check that the organization named is in fact a C3 organization. Also important to note that foreign charities can be the recipients of charitable bequests at death and qualify for the estate tax charitable deduction. This is in distinct contrast to the rule about gifts during lifetime and the income tax deduction. To get an income tax deduction during lifetime, a gift must be made to a US-based organization. It cannot be made to a foreign entity. So a gift to Cambridge University during lifetime generates no income tax deduction. A gift, however, to Cambridge in America does, because Cambridge in America is a 501c3 organization. And the other thing I just want to point out here is beware of conditions on gifts, particularly beware of saying that the organization must do a certain thing, and if it doesn't do it, that then the gift will revert and go to your children. In those circumstances, maybe that gift will not qualify for the estate tax charitable deduction. So be wary of putting gifts on, and consult a lawyer if you want to do that, to make sure that you don't run afoul of that rule. Another thing to think about at death is how should a charitable bequest be funded? Many of my clients today fund their charitable bequests, particularly now that we have the 10-year cliff for paying out retirement assets, from their retirement accounts rather than from their other assets. Why? Because when they pay them from their retirement accounts, they not only avoid estate taxes, but the income tax liability that survives the decedent and gets passed over to the beneficiaries, that income tax liability is avoided if the retirement plan distribution is made to a charity. So a double tax saving when using IRA or 401k assets or the like, or 403b assets to fund charitable bequests. Next slide, please. So the other thing that I have confronted with clients in recent years is, should all of their bequests be in their estate plan to take effect at the time of their death? And the reason for that question is because, given the current high level of estate tax exemption, there may be no estate tax saving as a consequence of the charitable bequest, because all of the property could have been left to the children and there still would have been no estate tax. Furthermore, there's no income tax deduction generated for anyone, for the estate itself or for any of the beneficiaries of the estate, by virtue of there being a charitable bequest made in the estate planning documents. Now, there may be strategies such as providing in the document that charitable distributions can be made from the income earned during the estate administration period, or adding charities as beneficiaries to trusts that might be set up for children. There may be ways there to generate income tax deductions, but a straightforward charitable bequest, $100,000 to Cambridge in America, put into the terms of a will or to a pour-over trust, will not generate an income tax deduction. So no tax saving is generated potentially by that charitable bequest. In contrast, many lifetime strategies for giving generate significant tax savings. They obviously take the property out of the estate, so there is no estate tax because the property is gone. And then during lifetime, they produce income tax savings, and they may produce income tax savings, as in the case of a qualified charitable distribution from an IRA, by not creating taxable income in the first place, or they may generate tax savings by creating a deduction and maybe the avoidance of capital gains by giving away cash or giving away appreciated property during lifetime, thereby leaving potentially more assets that could be left to the family. Next slide, please. So, one of the things about making gifts during lifetime that I'm often told is not necessarily what a client wants to do, is that they actually want to leave a legacy. They want something that's going to take effect and be a remembrance of them at the time of their passing. And so the question often raised is, well, how can I maybe get an income tax saving, but possibly defer that tax, defer the timing of the gift? And it's in this context that I would suggest that donor advised fund accounts are extremely useful. Donor advised fund accounts allow gifts to be made during lifetime, generating an immediate income tax deduction. Unfortunately, donor advised fund accounts cannot be used for qualified charitable distributions from IRAs, but can certainly be used for cash gifts, certainly be used for appreciated property gifts. And under current law, there is no requirement to make a further grant request from this type of account at any time while the donor to the account is alive. It's obviously good practice, and I think that was what is intended. And I have many clients who use donor advised fund accounts to do their annual gifts, but they've also they've almost like created an endowment within the account, to be used in the future, and then to be used at the time of their passing for those legacy gifts. And so that's something I think to keep in mind, because the sponsoring organizations of these accounts allow you to leave directions about how to about what should happen with any balance that's left in the account after your passing. There are other strategies too that may allow for a tax deduction and allow for a delayed distribution. And I put down, two here, which also have the third advantage of providing a stream of payments back, because that is another concern that many clients express to me. Yes, I hope to be able to give Cambridge in America $100,000 at the time of my passing, but if I need it, or if I determine that my family needs it, then I'd like to be able to revisit that constantly. Well, oftentimes there are other techniques that at least allow for the donor some use of the money, while at the same time getting a tax deduction for part of the contribution and the knowledge that there will be an eventual gift. Two strategies I've listed here: charitable gift annuities, that many organizations, and I understand that Cambridge in America is not in a position to offer these currently, but which many organizations do offer. And charitable gift annuities is a technique that has to be offered by the charity itself. It's not something that you can go to a third-party provider to offer. And also charitable remainder trusts, trusts that will provide for either an annuity distribution or what is called a unit trust distribution to be paid back to the donor or to other members of the family for a set term of years or for lifetime, and that eventually, let's say at the donor's passing, provide for whatever is left to pass to charity. So both of these, the charitable gift annuities and the charitable remainder trusts, are two ways, again, to make deferred gifts to get a tax benefit, and in both cases to get some further economic benefit during or retained economic benefit during your lifetime. So with that, I have come to the end of my prepared comments, and I think what I'd like to see is if we have any questions. And so let me see what we have here. My first question is, can you give some advice on how to go about creating a charitable remainder trust? And the question also asks about a charitable lead trust for Cambridge in America, despite their inability to host one. So I think what that question is going to is that there are some charitable organizations in the United States, particularly some colleges and universities, but also even some hospital systems that have very active programs where either the charity itself or the charity and a third-party provider serve as trustee and run the trust accounts. Maybe there's a third-party provider providing investment advice, but the charity is overseeing the fact that payments are actually made, that income tax information is provided to the beneficiaries, and that all of the administrative and other fiduciary requirements are being fulfilled. Cambridge in America, I know, does not do that, but that does not mean that you cannot set up a charitable remainder trust that ultimately benefits Cambridge in America. In fact, you can set up a charitable remainder trust on almost any platform. And by that I mean you could go to very well-known investment firms with national presences that can host these accounts. You can serve as your own trustee of the account. You can then retain your own investment advisor. Maybe the investment advisor that is providing you advice with respect to your personal assets to run the trust. And you can hire accountants, and if you need further legal help after establishing it, check in with a lawyer every now and again to make sure that everything is being handled. But you can certainly run one of these accounts yourself. And my experience is that many of the larger banks and many of the larger investment firms are very well versed in what is required to run these accounts, are very well versed in helping you make the calculations from the accounts to work out what the distribution should be, and can provide an awful lot of back office assistance. So the fact that Cambridge in America does not host these accounts or does not have a program itself for these accounts should really not be an impediment to considering having a charitable remainder trust as part of your overall financial plan. And remember, as I've said, a charitable remainder trust can provide for an income effectively to be distributed back to you during your lifetime. It can give you an immediate income tax deduction equal to the value of the charitable component, what will eventually go to charity, present valued back to today. So you can get a charitable deduction for at least a portion of what you transfer to the trust, and it can ultimately fulfill your charitable goal. You can even retain the ability to change the charities of a charitable remainder trust. All that actually has to happen under a charitable remainder trust is that the remainder interest be distributed to qualified charitable organizations. And they have to be US organizations again because of the income tax deduction generated by the trust. And the final thing to mention here on this question is, you're probably thinking, yes, but then I'm going to have to expend a couple of $1,000s hiring someone like Martin Hall to draw up the trust document. Not necessarily. The Internal Revenue Service has published model forms for CRTs. And while I have been on record pointing out some of the inadequacies of those forms, technically those forms are fine and with and maybe a little bit of supplementary information to them, those forms can create a perfectly adequate, appropriate, and valid charitable remainder trust. Okay. Next question. Let me see if I can get to this one. How can we bring a racial justice reparations frame into our philanthropic estate planning decisions? Well, it's such an important question, I think, as we deal with everything that has been going on this year. And as many of us, as I mentioned earlier, I've had many clients think about what their priorities are. And many have turned, particularly to this issue and how can they use their philanthropy. One quick question to go, one point rather to go back to, which I made in connection earlier with the discussion of charitable bequests at death. To get a deduction at death, property has to go to a C3 organization or its equivalent. It cannot go to those C4 organizations. Now, the difference mostly between a C3 and a C4 is that C4 organizations are permitted to engage in a lot of political activity, whereas C3 organizations are generally prohibited from, well, they are certainly prohibited from entering into any political campaigns. They are prohibited generally from lobbying efforts for the most part, and they are limited to advocacy. And of course, we think about those words, political campaigns, lobbying, advocacy. One person's advocacy might be somebody else's lobbying. And so there's a lot of gray in that area. So C4 organizations are free to do a great deal more in this arena. But as I've mentioned, be careful. C4 organizations do not qualify for the estate tax charitable deduction. But that having been said, I think that there are many charitable organizations through their advocacy, or many foundations that are associated with social justice organizations and the like, to which you can steer your philanthropic dollars. And I would also, have you think about the organizations that you have been benefiting traditionally, because many of those same organizations today are engaged in the same analysis about how can they better address the needs of society. How can they better address particularly these issues of civil rights and reparations? How can they broaden their approach, and how can they be more welcoming to all who come through their doors? So, take a good look. If you've been supporting your local museum, maybe your local museum has now developed a fund directed at these types of issues. If you've been a big supporter of your local hospital or health group, maybe that organization has upped its efforts at outreach to ensure that there are more resources available, particularly to minority communities or communities that traditionally have not been well served, to provide them with healthcare, to provide them with neighborhood health resources. So, I would encourage you to not only look to organizations that might be organized specifically for these purposes, but look to the organizations that you've traditionally supported. And maybe even if you're a big enough donor, prompt some of those organizations, if you don't think that they're doing what they should be doing, to improve their outreach. And maybe your gift might be the catalyst for them to start an initiative in that area. Okay. Next question is dealing with retirement accounts. And the question points to the fact that legislation that was passed earlier this year, the so-called CARES Act, made some temporary changes with respect to retirement accounts. One of the temporary changes was that it waived the requirement for those people who had already reached the age by which they are required to take money out of a retirement account. They waived the requirement for this year only to take that so-called required minimum distribution. And the question that's been put to me is it still worth giving a qualified charitable distribution from my IRA, even though I don't have to actually take money this year from my plan? And my answer to that is, well, it depends. And I think it's always good to do some analysis. But as a rule of thumb, I would say the answer is yes, because each year, if you have reached age 70 and a half, you are permitted to take out up to a maximum of $100,000 from your IRA and give that directly to charity in something called a qualified charitable distribution. And that distribution doesn't count as income on your tax return. You don't get a tax deduction for it, but it never enters the income calculus, which could potentially affect your income tax rate. It could affect whether you're subject to the 3.8% tax on investment income. It could affect even the taxation of Social Security. So I think that it's important to weigh that, but also remember, if you don't do it this year, you lose that ability to give that $100,000 to charity and not have it count as income. Okay. Next question.
Sorry to interrupt, Martin. I just want to thank everyone for their questions today, and just give a quick reminder, we have about 5 minutes remaining for the Q&A.
Okay. All right. So let me just see. The next question says, as a simplification, it seems that if the estate will be below the threshold for federal estate tax, there aren't really any tax benefits from donation after death. Is that correct? And I would say, as a simplification, yes, that is correct. However, I have for many clients drafted or amended their estate plans to provide that in addition to distributions that can be made after their death to their children, the trustee is also, in certain circumstances, permitted to make distributions to charity. And those distributions to charity from those testamentary trusts, those trusts created after death, will qualify for an income tax charitable deduction at the trust level. And trusts don't have a cap on how much they can deduct. So if a trust can effectively wipe out all of its taxable income by making a distribution to charity in any given year. So that can be an effective way of still creating a deduction. But as a simplification, yes, that is correct. And let me just quickly see if I can get in this next question. It says, what are the limits on income tax deductibility of currently donated funds in the same year as income earned? Does it make a difference whether this income is salary or capital gains? Is there a way to sell a business so that partial proceeds go to Cambridge without taxing the seller of the business? Wow, there's a lot in there, and maybe not. I don't really have enough time to address all of that. But basically, yes, there are limitations for income tax purposes on how much you can deduct in any given year. In fact, this year, there is the limitation if you give away cash is actually all of your income. So this is a strange year in which you can effectively wipe out all of your income tax liability. But ordinarily, there are limitations, and there's a complex set of limitations depending on the type of charity you're giving to and the type of property you're giving away. And those limitations can be 60% of your adjusted gross income, or 50%, or 30%, or 20%. So it can be awfully complicated. But one thing to keep in mind, and that's implicit in this, is that your tax deduction is not actually tied to the income itself. So if let's say I have a salary, I don't actually have to give away my salary or the cash that I put in my bank account that represents my salary to get a deduction against my salary income. Let's just say that a few years ago, I bought some Apple stock and I was very prescient and it's gone up a lot in value. I can give away that Apple stock to charity. I can get a deduction as long as I'm giving it away to a qualified charity. I can get a deduction for full fair market value of the Apple stock. I don't pay any capital gains, even though that stock has appreciated. And my charity, of course, doesn't pay capital gains tax because it's a tax exempt entity. So I can give away a gift of property. I can offset the deduction that's generated against my salary income. So we don't have to tie what's given away to the actual income that's being taxed in the year in which it's being taxed. And the final part of this about, well, can I sell my business and avoid tax on part of the proceeds by giving the proceeds to Cambridge? The answer to that is you will certainly realize all the proceeds if you owned the business at the time you sold it. You could then give away some of the proceeds and get a deduction to offset some of that income. But depending upon the nature of the business, you might be able to give away part of your business before you sell it, then have it sold by you and your charity, and then you never realize the income that would otherwise have been generated by the portion that you've given away to charity. And furthermore, based on an appraisal that would be needed, you would get an income tax deduction for the value of the business interest that you gave away before sale. One last word, and this will be, I promise, my last word today, will be, in that circumstance, careful as to when you make the gift. Because if you make the gift too late, in other words, you have a buyer who's already signed a purchase and sale agreement, then you cannot lose the income tax liability associated with the sale of a whole business because you've waited too long. Because effectively you've sold a right to, or you've given away the right to the income or the proceeds of sale, not the business, if you already have a valid contract in place. So with that, I think I will finish up the questions, because I think we're at the end of our time. And I thank you all for your time and attention today. I hope that what we've discussed today is helpful. And I would just make a pitch for my good friends at Cambridge in America, that if you have any questions for them, particularly with respect to how to make a gift to Cambridge in America, I am sure that they would love to hear from you. Thank you.
Thank you, Martin, for so eloquently describing why making sure we have an effective estate plan in place is important, and how we can make the most tax-efficient charitable gifts to support causes that matter the most to us. We are incredibly fortunate to have you with us today. Thank you for your time, your deep expertise, and for thoughtfully answering many of our listeners' questions. As many of you will know, much of Cambridge was founded by planned gifts, and they continue to be a crucial source of support for the university and its 31 colleges today. It is because of alumni and friends like you that Cambridge in America is able to support the mission of our institution and help ensure it continues to provide outstanding opportunities to future generations of academics, researchers, and students. To those that have joined us for this conversation, if you are interested in learning more about planned giving, you can find detailed information on our website at cantab.org/plannedgiving, or please feel free to email us at plannedgiving@cantab.org, and we will be delighted to speak with you. On behalf of Cambridge in America, thank you for joining us today and for being vital members of our community. We hope you enjoyed the presentation, and we look forward to continuing to connect with you, for now in a digital capacity, and hope to see you at future events. Thank you.